Welcome to the Tuesday edition of Tech Stocks Daily, where we've got a jam-packed lineup of the latest buzz in the tech stock arena. Get ready as we dive into DocuSign's roller coaster ride of unusual options activity and their AI-fueled innovations that are catching investor eyes. We'll also explore Microsoft's hesitation on Bitcoin gambles while flexing their financial muscles. Over at Google, you'll hear about their jaw-dropping advancements in quantum computing alongside some cheeky regulatory drama. And we can't leave Oracle out. Despite their stocks taking a dip, there's a glint of hope in their AI enterprise journey. Buckle up for insightful exploration, predictions, and humor about what makes these tech players the talk of Wall Street. Let's unravel it together. Guess who's signing all the big headlines today? It's DocuSign, a digital titan carving out its signature space in the tech world. This company is making waves, and it's not just because they're letting you sign on the dotted line over your morning coffee. Let's dive into why DocuSign is getting all this buzz. First off, things got spicy with some unusual options activity. Yep, Benzinga's tracking system caught some high-rolling investors throwing down hefty bets on DocuSign. We're talking 13 significant trades with a fervent mix of one put, soaring at $44,400 and 12 calls, sky high at a cool $591,492. Even though we don't know exactly who's behind these trades, such moves often indicate some insider savvy. Are they holding a crystal ball? Possibly. But what's certain is that the spotlight of investor interest has shifted towards DocuSign, and it's thrilling. Now let's unpack the play-by-play of DocuSign's stock dynamics. Currently, there's a split vibe among these big money trades, but a slight majority are feeling bullish, with just 38% holding a bearish view. The attention is all on a price range between $60 and $110, and the trading volumes have been off the charts, contributing to a substantial open interest. DocuSign, founded in 2003 and publicly launched in 2018, has mastered the agreement cloud, letting businesses digitally manage contracts in a seamless electronic whirlwind. No pen needed. But hang on, DocuSign's been dabbling in more than just digital paper routes. Meet the Intelligent Agreement Management Platform, a new feature that's tackling what's known as the agreement trap. This awesome tech uses advanced AI to help businesses save big bucks they might otherwise lose through sloppy contract procedures. With tools like DocuSign Navigator and its no-code creation Maestro, companies are seeing impressive enhancements. DocuSign AI adds even more pizzazz by automating agreement lifecycle tasks like drafting and risk assessments, proving to be a savvy sidekick for efficiency. In the financial arena, DocuSign's Q3 results were sparkling. $755 million in revenue, outstripping expectations, and causing a stock price zing of more than 27% soon after announcements. The net income saga is even juicier with an impressive 60% increase year over year. Now, while their stock is hovering around $104, far from its pandemic-induced high of about $310, the upward trend paints a pretty picture for potential growth. Investors might still find it a juicy buy as long-term gains are in the air, given DocuSign's increasing foothold in its enormous $50 billion market. In a nutshell, DocuSign has amped up its game, breaking out of e-signature territory into broader digital solutions laced with AI brilliance. The soaring stock prospects roar that even if you haven't yet auctioned your cheddar on this company, staying tuned to its waves could very well redefine how we think about agreements and digital paperwork in years to come. Grab your popcorn because DocuSign is undoubtedly in the band of tech titans to watch. Hey tech aficionados, let's dive into what's been shaking up the world of Microsoft today in the bustling tech news sphere. First things first, the talk of the town has been Microsoft's annual meeting, where a proposal about Bitcoin had everyone's keyboards clicking at top speed. Microsoft shareholders had the chance to vote on whether the tech giant should stash a slice of its colossal $78.4 billion in cash and marketable securities into Bitcoin, a mere 1% of it, to hedge against inflation. This soundbite came courtesy of a proposal from the National Center for Public Policy Research, a conservative think tank with a financial carrot to dangle in front of Microsoft. Despite the fancy presentation and advocacy from Michael Saylor, the executive chairman of MicroStrategy, who we know has been bullish on Bitcoin since long before it was cool, the shareholders collectively said thanks, but no thanks. Saylor tried to sweet-talk Microsoft into making Bitcoin the Beyoncé of its investment strategy, highlighting how his company saw a stock surge of 2,500% since adopting Bitcoin as part of its treasury strategy. He pointed out that maybe, just maybe, Microsoft had missed out on $200 billion in hot potential by opting for more traditional routes like stock buybacks and dividends instead of jumping on the crypto bandwagon. But it seems Microsoft's board was in no mood for the wild roller coaster ride that is cryptocurrency, specifically pointing out Bitcoin's notorious price shenanigans. Basically, they weren't raising their corporate levels of zen by ditching tried-and-true financial strategies for something riskier than a plate of sushi at a gas station. You can almost hear them stressing stability and predictability in their sleep. On another note, Microsoft found itself under the magnifying glass when compared to its competitors in the software industry. The company's performance paints quite a picture, punctuated by talk of undervaluation with a low price-to-earnings ratio and a price-to-book ratio that could signal untapped growth. Despite a bit of underachievement in terms of return on equity, which looks a little droopy compared to peers, Microsoft makes up for it with a high earnings before interest, taxes, depreciation, and amortization that's far above the industry average. Essentially, they seem to trade a little bit like a Lambo running on Toyota money, a fitting metaphor for their robust cash-generating prowess. Moreover, Microsoft's revenue growth is outstripping the industry norm like a Tesla Abyss gearing on a bird scooter. And with a debt-to-equity ratio that's gentler on the debt front, Microsoft remains king of the hill in financial stability, highlighted by a promising operational outlook. So yes, Microsoft might be saying no to crypto right now, but their market maneuverings and strategic placements continue to keep investors grinning from error alert to rollback. Here's to seeing how they channel that innovation and rain on the software parade. Buckle up, tech enthusiasts, because Google is making waves in the quantum realm and courting regulatory spotlights simultaneously. First off, Google has dazzled the tech world with its latest breakthrough in quantum computing. Say hello to Willow, Google's new quantum computing chip under the Quantum AI initiative. Unveiled to much fanfare, this chip focuses on tackling a crucial hurdle in quantum computing: error correction. In what can only be described as a blink and you miss it leap forward, Willow achieved an exponential reduction in error rates as more qubits, those quantum bits that are the fundamental units in quantum computing, were added. Think of Willow as the tech equivalent of Douglas Adams' Improbability Drive from Hitchhiker's Guide, minus the talking whales and petunias. So what's truly breathtaking here? Willow completed a benchmark computation in under 5 minutes. To put this achievement in perspective, the world's most powerful traditional supercomputers would need around 10 septillion years to do the same. That's longer than the age of the universe itself. Forget simply making faster computers. Google just went full cosmic with its quantum aspirations. Not only is this short-circuiting investors' synapses with excitement, but it's pushing Google's stock up around 4.31%. Why all the market frenzy? The long-term potential applications of quantum technology are veritable gold mines for sectors like AI, medicine, and sustainable energy. While Google was earning tech innovation medals, it was also caught under the regulatory microscope in Europe. News broke about the European Commission probing into a secretive ad deal, or what might as well be labeled a digital conspiracy, between Google and Meta, highlighting their covert operation dubbed, wait for it, Tangerine Owl. There's a spy thriller waiting to be written, but for now, it's serious business. Google employees reportedly shared tips with Meta on bypassing Google's own stringent ad policies to target minors and undefined, unknown demographics, largely minors, with Instagram ads on YouTube. Google recently slammed the brakes on this operation, reinforcing its policies and highlighting its staff's accountability, yet the regulatory scrutiny continues unabated. While Google did taste a sweet victory by overturning a previously hefted €1.49 billion antitrust fine in court, the company remains squarely in the sights of international regulatory bodies. The pressure builds amid deeper investigations into tech giants, ambiguous data handling, and advertising tactics. In summary, whether they're revolutionizing tech with quantum feats or recalibrating their policies under a magnifying glass, Google remains an omnipresent force hammering away at digital borders. From astronomical computations to biochemical potential and blistering ads disputes, Google's story today reads like a constellation of future-forward visions, with a few lessons in humility from Big Brother. Stay tuned, because this could spell either extraordinary advancements or just another chapter in big tech versus regulators, the unending saga in our universe of Silicon Valleys and quantum particles. Oracle, in the spotlight today with a not-so-glamorous dance through the stock market, made headlines after releasing its financial results for the second quarter of its fiscal year. Unfortunately for Oracle, this isn't the kind of news that sends investors popping champagne bottles. Instead, it was more of a hold-on-to-your-seat moment, as their stock price plunged by a whopping 6.67% in early trading hours and dipped even lower after hours to 7.80%. So, what went wrong? Oracle reported non-GAAP earnings per share of 1.47 cents on sales of $14.1 billion. Now, if you're thinking, wow, those numbers don't sound half bad, you'd be right in terms of absolute figures. But here's where we cue the ominous music. Wall Street analysts, with their treasure map expectations, had called for earnings of 1.48 cents per share. The moral lesson here: being off by a penny in per-share earnings can apparently rain on your parade. But it's not all doom and gloom. On the other hand, Oracle's cloud segment didn't just rest on its laurels. It amped up with a solid performance, a 24% increase in segment sales, with its cloud infrastructure revenue jumping a remarkable 52% year over year. Those are the kind of gains that would make even the most stoic investor crack a smile. However, analysts saw a downside as Oracle's guidance for the next quarter fell short, a potential sign that caution flags are being waved amid cloudy weather. And speaking of cloudy, Oracle fearless strategists and vindicators also graced headlines today with more positive musings. Dan Ives, a managing director at Wedbush Securities, brought some light to Oracle's dark financial cloud, stating that the company is poised to benefit from the big bang of enterprise AI applications. Ives painted an optimistic future, explaining that the next century, we mean the next 12 to 18 months, could see Oracle benefiting materially from AI's pervasive influence, especially in enterprise software. Think of it as AI applications going mainstream, and Oracle being on the Galactica Express. While Oracle is grappling with current Wall Street jitters, the silver lining might just be its strong foothold in enterprise AI, promising gains looking toward 2025. Pivotal growth in Oracle's ERP offerings appears as likely as the sun rising tomorrow, according to optimistic forecasts. So, what do you all think out there in vlogger viewer land? Is this merely a blip for Oracle, or does this present a potential opportunity if you've got a Midas touch with investing? Do you think Oracle's voyage into AI could help its stock soar again, or will they need a bit more magic? Share your thoughts in the comments below. Let's get chatting on Oracle's highs and lows and potential leaps into artificial intelligence. Let's zero in on DocuSign for a moment, which clearly stole the limelight today with its roller coaster options activity and impressive financial surge. Given the current weather in the tech stock forecast, here's why DocuSign might be catching the eye of savvy investors and whether it's a good time to buy, sell, or hold. Big money movers have been enthusiastically dialing in on DocuSign, showing a strong bullish sentiment, despite a few lingering bearish clouds. With the hype around DocuSign's cutting-edge intelligent agreement management platform, the company proves it's not just about e-signatures anymore. It's adding AI jazz to fold, promising efficiency and minimized risks. Pair this with stellar Q3 financial results, boosted revenue, and a dazzling 60% year-over-year income increase, and it's clear that DocuSign is tapping into a $50 billion market with untapped growth potential. Though their stock is currently chilling at about $104, a significant dip from its pandemic peaks around $310, the signs are pointing to a bright upward trajectory. For those with an investor's pulse, this could possibly be an opportune buy. The rationale here? With its innovative AI-driven platform enhancing business contracts and continuing market expansion, there's a promising horizon where DocuSign continues to gain market share and perhaps gives a hefty high five to investor portfolios down the road. However, it's crucial for investors to conduct their own due diligence. DocuSign, like any stock, can be subject to market whims and sector volatility, especially in a tech landscape that's continually evolving. Staying informed and keeping an eagle eye on ongoing developments will help each investor decide the right move aligned with their financial goals. But remember, I'm here to illuminate the path, not plot it for you. Keep your research game strong and consult your financial advisor to make the best decisions in line with your unique investment strategy. Happy investing, tech aficionados. In today's tech news extravaganza, we've witnessed a whirlwind of market activity. DocuSign blitzed the scene with its dynamic moves, riding high on bullish sentiments and groundbreaking AI advancements. Microsoft played a more cautious hand, rejecting flamboyant Bitcoin proposals while still dazzling with its rock-solid financial footing. Google continues to rocket through the universe with quantum chips while navigating regulatory turbulences. And Oracle waltzed through the market with mixed emotions, but there's hope on the horizon with enterprise AI antics on the horizon. If you enjoyed this deep dive into the tech stock cosmos, don't forget to smash that like button, hit subscribe, and share the tech love with others. We'll be right back here tomorrow with another sizzling breakdown of the latest and greatest in tech. Stay tuned and keep those notifications turned on for more.